All right, so I received an email this week after we went over options myth number 10, requesting, Ray down in Houston wanted us to do a summary of the 10 options myths because the series has been going on for 3-4 months now, and you might have come in the middle or whatever. So it seems like a good thing to do to summarize all of these myths, because if you can, every one of these myths comes from our personal experiences, my personal experiences. I've pretty much fallen into every one of these traps over my trading career. And the purpose of these kinds of lessons is to give you the opportunity to not fall into these same traps. It will speed up your learning curve if you learn from people who've made mistakes and you don't make those same mistakes. Some of them you inevitably will because there's such a lure to do these things, but hopefully you can get some wisdom from these 10 myths and try to avoid as many of them as possible. So myth number 1 was, I'll trade the same with $5,000 of capital as I will with $500,000 of capital. No, you won't. You won't. You're going to trade a lot more conservatively because so much more money is involved, and human nature is going to cause you to be more careful. And so you can't quite assume the returns that you made when you were trading $5,000 will be the same as $500,000. It usually doesn't work that way. Myth number 2 is a technical myth. If you are buying a spread on the call side and you want to take a look at that same spread on the put side, let's say an iron condor, or sorry, a condor on the call side or a condor on the put side, you compare which one's cheaper and then you buy the cheaper one. That's an illusion. Both the call and the put condor are going to fill at the same price because of put-call parity. So don't waste your time. Just find the right price and enter into the trade. Thirdly, here's one I love. I can own a call for free if I finance it, and I put quotes around the word finance, if I finance it with a put spread. And that's the same as an insurance company saying, I can go out and buy a new Mercedes by selling a super risky policy to someone and taking the premium and then go spending it on the Mercedes. Well, what you're forgetting in that analogy is, yes, your cash flow is 0, but you just entered into a gigantic risk. And that's what happens when you double down basically on your bullish call by both buying a call and selling a put spread. Fourth is, you can't make money in a low volatility environment. That's something that people believe because they're not getting the same prices for their trades as they did in previous periods where things were more volatile. But what they're forgetting is that low volatility can stay around for a long time, and as long as the volatility environment that you entered the trade in is about the same as the environment you exited the trade in, then because of the time decay of options, you should actually make money on those trades also. You can make money in a low volatility environment. Number 5, options income trading means I can pay my bills with options trades each month, right? Because it's options income. That's a misnomer. I don't really like that term. It misleads people. You can't think that way. You're going to have losing months. You've got to pay your bills somehow, and you can't pay them with negative dollars. So what you need to do is understand that it's a return. You're obtaining a return over a long period of time, and you have to do some cash flow planning for the times where you'll have a negative month or two, which absolutely will happen. Options myth number 6. I can improve my returns dramatically by buying out of the money calls. They're so cheap. If I'm right about the stock, I'll make a fortune and only have a tiny investment in it. Problem is, most of the time, if you buy way out of the money calls, they will expire worthless, meaning your investment you just lost 100% of. So unless you have an odd definition of improved returns, buying way out of the money calls is not a very good way to improve your returns. Option myth number 7, my backtesting results are great, so therefore it will trade exactly as I backtested it. And this is in reference to a particular strategy that you've gotten interested in. Well, you won't trade it exactly as you backtested it, primarily, honestly, because of emotions. Most people can't completely control their emotions, and they end up making, they end up not following their backtests and improvising and then screwing the trade up, to be honest with you. The second big reason is execution, and in a backtest, you're looking at mid prices, but in fact, many times it's difficult to get filled at exactly mid prices. So your backtests, your live trading is probably going to be somewhat worse than your backtest, and you need to kind of factor that into your thinking. Number 8, this trade's too expensive today. I'll wait till tomorrow when it gets cheaper. We're in the game of time decay, and odds are it's not going to get cheaper tomorrow. In fact, odds are it's going to get more expensive tomorrow. So waiting for that better price, you may end up skipping a whole month. And that's bad if your income is predicated on keeping your capital in the market at all times. Number 9, I will eventually find the holy grail trade. I just have to look hard enough. And no, you won't. There is no holy grail trade. There is no trade that doesn't have any weaknesses. There is no trade that has no markets in which it fails. It doesn't exist. Stop looking for it. Start looking for trades that are reliable and have strong risk management components to them that you can trade relatively consistently and safely over a long period of time. And then finally, my strategy is not working. I'll just trade what everyone else is trading. I hear everyone else is trading this strategy and it's making all this money. I'll just start doing what they're doing, and then I'll start making money. The problem with that is what you're not realizing is that trades go into cycles. Certain cycles are very strong for that strategy, and then you can go into a rough patch for that strategy and fall into sort of the negative cycle. And most people wait long enough that they've basically exhausted the positive cycle on a trading strategy, and they'll jump in when it's going to experience a rough patch. So what you'll end up doing is just jumping from strategy to strategy to strategy. All of them used to be profitable until you got involved. And so that's a very common problem. It's called chasing returns, and it basically doesn't work. So if you recognize any of these 10 myths, and you recognize that you're doing it, my recommendation is stop, because these are not successful ways of thinking. A solid trader thinks properly, thinks logically, thinks honestly, and makes his decisions based on reality as opposed to wishful thinking. So I hope that this series of top 10 myths has been helpful to you. I hope that you really do some thinking about whether you are in fact thinking along any of these lines, and take my word for it, these thoughts don't work. They will impede your growth as a trader. Once you get past them, you will be a better trader. Thanks very much, and we'll see you next week.